All right, we are live, Peter.
Awesome. And thank you for hitting that record button. I would have never remembered that.
No problem.
All right. Welcome in, everybody. We'll give a minute or two to let folks stroll into the webinar. How you doing today, Andrew?
I'm doing quite well, Peter. How are you doing?
I'm doing well. So for those of you who haven't met Andrew yet, he heads up marketing here at RL Property Management, and he's been a great addition to the team. He's created this slide deck template, which looks awesome. The slides that I used to make, you probably saw some of them, Andrew. It's like it's like white with just like black text. There's like nothing. There's no graphics. There's no,
Yeah,
that's what happens when an engineer makes a slide deck.
sure. Yeah. Well, I like design and I like content creation, so it's always my pleasure to help out with that kind of stuff. I got to let you know, Peter, I'm super excited for this month, but also next month's webinar topics. They're hitting close to home for me right now as I'm considering upscaling or upsizing my house. I've
Yeah.
I've played around with the idea of renting out and just have no idea how to calculate like what could I potentially make off of it? Would I be in the hole? Would it be a good rental
Yeah.
investment to keep around, or is it better to just move my equity into the new
Sell versus rent
into a new
calculator.
home? Yeah,
Mm-hmm.
exactly, exactly. So, a little bit maybe not fully on topic with today, but next month when we get talking about building that pro forma, it'll be good. So,
Yeah. Awesome. Well, we'll kick off. So thanks everyone for showing up today, and hopefully we're going to deliver massive value over the course of the next hour. I'm going to try and share everything I know about calculating and tracking rental property performance, which is kind of what we're all doing here. So we will just a quick background on who I am. I won't go through this in detail. You can read this if you want. Basically, backgrounds in engineering, and then I started RL Property Management in 2013, and I've just been totally immersed in professional property management for the last 12 years or so. I write and speak about the topic nationally, and I really like the industry. I like rental properties. I like property management companies. I like just trying to figure out how to make them run well and how to deliver great results for our clients. And I'm also a real estate investor myself. So I own six or eight, I forget how many rentals with my partner. And we've owned those for many, many years. So, what are we doing here? All right. So, this is a webinar series that we originally created for our clients at RL Property Management, the property owners. And we have about 300 plus property owners that we work for, managing their rental homes and apartments all around Central Ohio. And we actually opened this up to folks that aren't clients as well because we thought, hey, this is educational, this is useful information. Why not make it more broadly available? For those of you who are clients of RL Property Management, we took a survey early in the year and we realized that 2/3 of you don't have the confidence that you would prefer when it comes to real estate investing. And so we aim to change that over the course of this year by doing one webinar per month, purely designed around informing and educating property owners on everything they need to know about real estate investing. And so we'll have more information on next month's webinar, which is all about how to evaluate a potential purchase or a potential rental property. We'll share a link on how you can sign up for that so you don't miss it. All right, so here's what we're going to be doing today. We're going to do some quick company updates. Then we're going to look at a property that's available for sale right now. And you're going to get to guess how much it's selling for and how much the rent might be. And then we'll do a reveal at the end of the hour. And we'll have more information if you want to look into that property. And then we're going to get into the details about how to understand if your rental property is actually making you money, which is what it's all about. And we'll get into just a couple other odds and ends along the way. Andrew, anything I'm missing here? Any Q&A off the bat we want to get into?
I don't think so, Peter. I do want to just do a quick tech check in the chat. Let us know if you can hear us and if everything is working well. One person said they had no sound, but I think other people can hear us, so we should be good. Um, Fixed it.
Okay,
Okay,
cool.
awesome. Thanks, Allison.
All
Good to go.
right. Yep, great. So, just a quick update on the company. So, like I said, I started the company in 2013 with my co-founder Adam Rich, and we managed just shy of 700 units. I think I saw we were at like 690 ish. So, if you have 10 units that you'd love for us to manage, please text me. I will end the webinar right now and get on a call with you because we really want to hit that 700 door mark. We've got 33 people who work here. Their sole focus is property management. We don't do brokerage. We don't do HOA management. All we do is residential rental property management. The company photo is a little outdated there. The team's gotten a lot bigger. In 2025, we've completely reoriented the company around you, the property owner. We've made that a huge focus. We brought in new leadership. We're developing new systems, and we're really making an effort to take everything to the next level for the property owner. So if you're a client of RL Property Management, I'd love to hear from you if you're noticing any changes now that we're just about 2 months into the year. Scorecard. So we are one of the only property management companies that I know of that publicly shares data on how they're doing. So when you hire a property management company and they talk about, oh, our lease renewal rate is this, and we collect rent 99%, blah, 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 you never actually get to see any of that data and confirm it. And we decided that we wanted to be different. And so if you go on our website, you can actually click and view this in real time. We update it once a month. So if you're curious about what it might be like to have a property managed by RL Property Management, or if you do have a property managed by RL Property Management, this will be even more relevant for you. But these are some of the most important metrics that we track to understand how we're doing as a company. Now, for years, we tracked these metrics internally, and we would monitor them, and we would talk about, if the lease renewal rate started to drop or occupancy, we would take different actions. But just recently, we started sharing this publicly. And so I love this transparency. I think it's important for property owners to be able to make an informed decision about their property manager. And there's just a couple other property management companies who are doing something similar around the country. And I don't know, I think it's kind of cool. So we pop that in there every month. So if you tune in next month, you'll get to see it again and see, which direction these numbers are trending. All right, let me introduce Brittany Pilifant. Brittany, welcome on. And what do you have here for us today?
Hey, can you hear me?
Yep.
Okay, perfect. My name is Brittany Lohmann. I'm with Howard Hanna Real Estate Services. So just a little background information on me. I got into real estate in 2014 after I graduated from Ohio State. I've been working with RL for many, many years. They have a great retention rate, which I'm sure a lot of you have experienced if you've already worked with them, which my clients love. So anytime I have a new client that's looking to purchase any, buy and hold investment properties, I always send them RL's way. So I wanted to introduce a new build opportunity out in Asheville, Ohio. It's a 4-bedroom, 3-bath, 1,510 square feet. What's different about this builder in particular is they're not a custom builder, but they do set each home on that specific lot. They will already have these selected finishes, and they actually do select finishes that are trendy, high end. So when they're giving you, a good value for the property, it's coming with actual, items that you'd want in your home, like modern stainless steel appliances, which is great. The 2-car garages. At the end, when we do the rate reveal, I'll give you some of the builder finances incentives as well, and what the current interest rates they're able to offer.
Great. Do you want to talk about this at the end or now?
We can talk about it now if you want.
Okay.
So exciting news for Ohio is Anduril Industries is to build a $1 billion facility in Pickaway County. Pickaway County is located in South Columbus, south of Franklin County. Anduril is a Southern California-based defense technology company that contracts with the U.S. military. So one reason they are choosing Pickaway County for this is because we do have the smaller airports in that area they can utilize. Production is expected to begin in July 2026. The plant will span 5 million square feet and will create 4,008 direct jobs by 2035. Project also anticipates to create a total of 4,500 indirect jobs over the next 10 years. Over $1 billion in in-state labor income will be generated, and projected tax revenues are estimated to be roughly $800 million. So fortunately for this area, since it's going to be bringing in so much workforce housing demand is builders have already started building in these areas, mainly because there was still land available to build on. The need for housing inventory has been so high that they've already kind of went this direction. So areas that will kind of want to like just keep an eye out to keep on your radar would be Asheville, South Bloomfield, Commercial Point, Orient. And what a lot of these do have in common is that Tays Valley School District, which is currently graded at a B, so which is great. So it's a great opportunity. Housing demand plus the top rated schools will ensure the strong occupancy and long-term tenant retention if you were to kind of keep these as a buy and hold investment property for yourself.
Brittany,
so I'll kind of go through later when we do the.
We had a question on who is the builder?
D.R. Horton.
Okay.
But outside of D.R. Horton, there's about 4 other builders that are also building in these areas. I just work closely with them, so I wanted to kind of show you their product first.
Yeah. Okay, cool. So this is a great lead-in. So the last sentence there on the slide says, infrastructure growth makes Asheville a prime submarket for long-term ROI. And we're going to be talking about ROI today. What is ROI? How do you calculate it? So before we dive into that, I got one last slide here that I thought was really cool, and we got permission to share this. Jason Ferrier, who I don't actually know, Jason, he shares this graph regularly on LinkedIn and updates it once a month. And it shows all of the different school districts and what's going on in terms of whether they're like a buyer or a seller's market. So I happen to be in Reynoldsburg. That's where my personal residence is. And so you can kind of look up and see, like, is this more of a buyer market or a seller market? Which direction is it trending? Median price. So I thought this was kind of a cool thing. He shares some other really interesting data pretty regularly about Central Ohio housing market. So just a shout out there. I thought that was cool. Okay, let's get to the main topic. Your rental property or properties, is it making you money? Good question, right? And I think a lot of us just sort of look at the monthly disbursement amount that you receive either from sort of rent minus your expenses or, net from your property manager, and draw some conclusions based on that money that you're getting or not getting. And what we're going to go over today is, how do you really know if you're making money or not making money? And then what are some different ways you can look at that, and how should you be evaluating the performance of your rental property compared with other ways you could invest your money? And I think, the property management world that I live in is very, very focused on operations. We're very focused on placing tenants in the property, collecting the rent, dealing with maintenance, turning over units. And that's all great. And the end result of that is you get some money flowing your direction. What we don't spend a lot of time on as property managers is helping our owner clients understand how they should be thinking about the stream of money that they're getting. And as an industry, we've sort of left you to your own devices on understanding how to interpret the performance or the results of your investments. And it's unfortunately, it's much more complicated than just looking at like stocks, for example. Like if you look at the stock market, you can kind of see like, oh, I bought Tesla stock and it was this price and now it's this price. Well, that's a much harder calculation when you're talking about rental property. For one thing, you're not getting a real-time market update on the value of your home the way you are with the value of a stock, even though it's changing just as much. The other issue is that you've got this income coming off of the asset. So even though the actual value of the property might not be changing much, you can kind of think of that as the value of the stock. You're receiving the stream of income from the property. And what ends up happening is your mind focuses on that stream of income and sort of disproportionately assigns weight to the consistency and the amount of that stream of cash flow or of income off the property. And your mind kind of tends to ignore everything else that's happening with the property and with the investment. And so that's kind of what we're going to dive into today. We're going to unveil a lot of the other details and calculations that you really should take into consideration when you're making a decision like, Should I sell this property? Should I buy more property? Should I refinance this property? And unfortunately, that information is not readily available. And we're going to talk about why that is too. Okay. So there's confusingly a bunch of different ways to measure the performance of a rental property or any type of commercial real estate investment. On that last slide, we were looking at ROI, and NOI is kind of another way to look at ROI. Your net operating income is something you're going to hear tossed around a lot, especially around commercial real estate investing. By the way, we're going to go into more detail on these, but I just want to introduce them in case you've seen these terms kicked around. We've got cap rate, so that's NOI over value. And again, we're going to go into more detail. I just want to give an overview. IRR, that's an internal rate of return. ROE, or return on equity, and then cash on cash return. So all 5 of these metrics or KPIs or indices, however you want to think of these are all different ways of looking at how your property or your investment is doing. And some of these you can compare and contrast with like a stock portfolio, and others there really is no corollary with other investing asset classes because rental property is kind of a unique type of investment. And by the way, I forgot to mention, but this is a pretty casual conversation. So if you have questions, you have comments, please feel free to jump in, in the chat or the Q&A. This is meant to be like plenty of dialogue, plenty of back and forth. I want to promote some good discussion because I think that's where a lot of the good stuff comes out. So please feel free to jump in. Okay. So when you look at those, if you were to like Google some of those metrics that are on the previous page, there's like 1,000 tools online that you can use to calculate this stuff. And of course, most of them are trying to opt you into some kind of newsletter, and there's all this like you're like entering a marketing funnel when you like use one of these online tools. And honestly, a lot of these are geared toward helping you evaluate a potential purchase. And we're going to dive into that next month, as I mentioned. And that's a great thing. You need to have tools that help you evaluate a potential purchase of rental property. But there's a kind of a lack of tools designed to help you evaluate the performance of an existing piece of property that you already own. So we're going to be talking about that today. How do you evaluate the performance of a rental property that you already own? Because that's, if you're watching this and you're an RO client, that's your situation. You may not be thinking about buying another property right now. Why would you if you don't even know how your current property is performing? That's kind of the thing that gets me frustrated is we're not set up to talk about and measure and monitor these things that would help us understand the performance of these properties that we own. So I'm excited to help uncover this a little bit today. Got some bad news though first. So the property management software that we use at our company and that many other property managers use, they're not set up to help you understand any of this. I talked about earlier how property managers are very operationally oriented. We're extremely focused on the nuts and bolts, the day-to-day of dealing with the property. We're dealing with forwarding tenant mail. We've got online rent payments getting bounced. We're dealing with evictions. Like, we're so deep in the weeds here at the management company level that we're just not naturally oriented to sort of zoom out and help you evaluate the larger picture of your financial performance and like where the property sits in a broader context of your investments. And that's just, it's just kind of a thing that happens naturally. It's not that we're like trying to hide that from you or that we don't really understand it. It's just when your day-to-day is filled with tenants and toilets and termites and just all of these problems, you're just not in that mind space of like, well, let me get on a phone call and talk to the owner about how this property is, what it's going to be worth in 5 years. In fact, realtors are more oriented, like Brittany, they're more oriented in that direction because they're not so zoomed down to the ground of a day-to-day managing of a rental. A financial advisor really has no incentive to do this either because they're paid on a percentage of assets under management. And so they want to get you into stocks and bonds and mutual funds and index funds and all these kind of like financial products where they can set up their software so they get a percentage of assets under management, right? Classically, financial advisors would charge you like 1% of assets under management. And by the way, I've thought about, hey, what would it take? What kind of value would I have to deliver to you, my client, in order to justify charging you 1% of your asset value every year? Like, what would have to be true for that to be an awesome deal for you? That's something I'm kind of been thinking about in the back of my head for years now, actually. The other thing about financial advisors, and no hate, I have a financial advisor myself, they're just not trained on how to deal with real estate investments. They don't understand the risk. They don't understand the return. They don't understand the details that really are going to help you that are going to like make or break in a rental property as an investment, as a good investment for you. I already kind of talked about bullet point number 3 there. There's something else I want to hit on here. The vast majority of your profits, basically like your returns in rental properties, is going to come after you've owned the asset for like 5 or more years. And there's a bunch of things that go into this, but primarily principal pay down, which we're going to look at a slide on the next slide that's going to show this. Rent increases and property value increases. These things all snowball, right? They get bigger and bigger and bigger over time. So if you picture rent that goes up maybe like 3 or 5% every year, well, when you first start out, you first get the property, that rent amount is whatever that market rent is. It's just like going up a little bit every year. But the longer and longer you own that property, the more and the more rent goes up relative to what you paid for the property, the more and more that starts to really pay off for you because of this idea of like compounding where it goes up by a percentage every year. Like, in other words, the rent of a home, like a rental home, it doesn't go up by like $50 every year. You can picture instead it goes up by like 5% every year. Even if those numbers are equal in the beginning, over time, there's like this compounding effect. And so the longer and longer you can hold on to a property, the more and more that works in your favor. It just, the way the math works, it's like all the good stuff is at the end. So if you transact properties constantly, and we have some of our clients that do this actually, they're always like trying to buy and sell in and out of stuff. And the folks I see that get the most consistent large disbursements from our company, because I see all the numbers, right? They're the ones that bought a bunch of property a while ago and basically forgot they own them. They just let them, they're on autopilot. They're not worried about this month or that month or selling, or they just ride it. And it's just like the rent goes up and the property value goes up and the expenses stabilize and start to go down as we get the property positioned properly. And it really starts to get attractive for them over time. And I've seen this too with the properties that we own. I bought my first rental property in 2008, still own it. And you know, the mortgage payment, which at the time we bought that property felt like this unfathomable monthly burden, is now like a rounding error. Like it's like a joke, because it's just like the rents have gone up, the property values have gone up, inflation's gone up. And so, you know, these mortgage payments where they're this fixed dollar amount, you just don't realize how small that's going to feel to you in 15 or 20 years. So I talked about principal pay down. So if you've ever seen a graph like this, you know what I'm talking about. If you haven't, I'm about to blow your mind. What you're looking at here is in basically a graphical version of what's called an amortization schedule. So when you get a loan from the bank, let's say in this example, it's $300,000. Have you ever wondered why your mortgage payment doesn't go down over time? Because wouldn't it be true that like if your interest rate's 5% on 300,000, what would that be like the first year? That would be like $15,000 in interest the first year. And then like, what would it be the second year? Well, actually, if you didn't pay any principal, it would be the same amount. So how do they figure out, like, if you've ever really thought about it, you're like, how is the payment amount the same for the whole time that I have the 30-year mortgage when the amount that I owe is going down? Isn't that like kind of insane? Well, the way that they do this is they calculate the total amount of interest that you're going to owe over the lifetime of the loan, and then they spread it out to make the payments equal. It's kind of a really weird thing, actually. And so what you're looking at here is how those interest payments are distributed. And, you know, if you've dealt with banks, there's maybe no surprise that they loaded it the way that they did. They front load all the interest, right? So the interest is completely front loaded. There's no reason it couldn't be the other way around. Like picture the inverse of this graph. There's no reason it couldn't be that way, but no, they do it this way. So you pay all the interest up front. So in that first, 5 years, 7 years, most of your payment is going to interest. And I think a lot of people have heard about this, and that's something they've heard people say before. But there's something about seeing it graphically and seeing what happens near the end that really changes the game. And so when I say that things compound on the previous slide, you can start to see why. After you're 15 years in to a 30-year mortgage, in that second half, especially like the last like 1/3, your payment is like mostly just going to principal. So you're kind of like, it's almost like you don't even have a mortgage anymore. You're just taking some money from one pocket and putting it in the other pocket because it's almost all principal. So if you constantly transact and trade in and out of properties or refinance like every 5 years or less, you never get to the good part. You never get to this nice part where you're actually paying down your principal really, really rapidly and getting more and more equity in the property. So I don't know. I think this is a really interesting graphical way to display some of these things I'm talking about where like you got to stay in it for a while. All right, so now some good news. I gave you some bad news. Here's some good news. You're probably making a lot more money than you think you are with the properties that you own. And I'm going to talk about why that is. And the other piece of good news is that if you want to be really successful in real estate, just do nothing. And I talked about earlier how some of our most successful clients, they just bought a bunch of properties and basically tossed us the keys and said, see you later. And they just kind of let us do our thing, and the property goes up in value and the rents go up. And so that's a great thing about real estate. And it can be a truly passive investing asset class if you're paired up with a good property manager. You don't have to be, if you picture like the stock market, like if you're not buying index funds and you want to invest in like individual stocks, man, that has to be like your full-time job if you're going to have any hope of making any real money, because everyone is trying to outsmart the market and there's all these like really advanced algorithms and everything else. Real estate's nothing like that. You can just do nothing, and over a long enough time period, you will become extremely wealthy. And so that's the good news. All right, quick ad break. Did you guys know we have a magazine? We have a quarterly actual real deal magazine. It's not a digital product at all. You can't even get it online. And it looks phenomenal, and it's filled with all original content written for real estate investors. And so we'll drop a link. You can also scan the QR code. If you want to sign up, it's free. The only thing we ask is like you need to own a rental property within our service area, which is like Columbus, Franklin County, basically, or if you're thinking about buying one. So we'd love to have you sign up if you're not already getting it. We put a lot of work. Andrew does a ton of work to make this go out every quarter. We have a big list. Hundreds of people receive this. And we've got all kinds of original content. This isn't just like nonsense fluff. This is like actual things that we think property owners would benefit from knowing. Allison asked if agents can get the magazine. Yeah, why not? Throw your name on there, Allison, and we'll get you getting a copy of that. Okay. So all right. So here's more of the good news. There's 4 ways. There's 4 pillars of profitability when you own rental properties. And most people only think about the first one. And this is kind of like the meat of this presentation. 4 ways you build wealth, or 4 pillars when you own real estate, rental real estate. Cash flow. So that's like the money that hits your bank account every month. Everyone's familiar with that. Principal pay down. So that's like the slide that we're showing here. This is like a way that you're making money that you don't even think about. Because when you think about your mortgage payment, it just feels like an expense, right? Because it just, it's just money out of your bank account and it goes to the bank. But you sort of forget about, like that loan is actually getting smaller and smaller and smaller over time. And that's not actually an expense, right? That's just money that you owed that's getting paid off. So there's no real cost to you as you pay down that principal. And so if you're thinking in your head, well, my rental, I get $1,000 a month from my property manager. That's like net of all the fees and everything. And my mortgage is $1,000. So I'm really not making any money. Well, that's not true, because you're actually paying down the principal. And the longer you've owned the property, the more you're paying down principal instead of interest. Appreciation. So this is a big one, right? When we talk to property owners and they say, I didn't make any money this year. I'm like, well, I don't know. I feel like maybe your property value went up like 3 or 4 or 5 or 6%. Let's do the math on that. I feel like maybe you did make some money. And it's easy to forget that though, because it's kind of like phantom money. Like it's not cash in your bank account, but it's still building your balance sheet. It's generating wealth for you. And this is the one that really kind of sneakily compounds and is the thing that's going to make you the most wealthy over time. It's not the little $100, $200, net cash from the monthlies. It's going to be this appreciation and principal pay down. And so this is a huge, huge benefit of owning rental properties. And again, the stock market analogy, right? When you think about Tesla stock, you're focused on that stock value. That's the equivalent of the asset value, of the home value. Whether they're making net income this month or that month, or they're reinvesting income, you're not really worried about that when you own a stock. And it's kind of a similar idea with rental properties. So I love if folks focus on that asset value and how it's changing. And then the last one is tax advantages. So there's a lot of tax advantages of owning rental property. And one of the things that can happen with depreciation that you get to write off every year is you can actually have a situation where you are making money, you are getting free cash flow from your property, and you're not paying taxes on it because you get to write off that depreciation for the first 27 and a half years that you own the property. And that situation gets even better if you're a real estate professional. And I'll talk more about that later. So if we think about those metrics, which we're going to get more to those metrics in a second, it's really hard to come up with a metric that captures all of these. The IRR, the internal rate of return, gets closest because it captures those first three and is going to be the closest that you really are going to have when it comes to like comparing your like returns to the stock market, rather than just looking at the cash. Okay, I feel like I've talked a lot. Andrew, how's this hitting you as somebody who's considering starting a real estate investing journey?
Yeah, well, you hit the nail on the head there with like the main thing that comes to mind is like, all right, how much will I cash flow? Will I cash flow at all? And is that all that matters? And obviously the answer is no. It's that long-term, 10, 15, 20-year play that really makes this worthwhile. But where I don't have a ton of, capital to work with in the first place, the cash flow is important, right? And so I think it just depends on, kind of your unique position. But
Yeah.
but this is interesting, and I think it's really important to know because a lot of people do just focus on how much am I going to get back in my pocket every month, and that's not what real estate investing and wealth building is all about. It's important to, like you said, look at the long term and then look at all these other ways that you're building wealth that people often overlook. So.
Yep.
We had a question come in, and this is kind of related here. And Will asked, what are the best areas to invest in Columbus this year? So if you have any off the top of your head, I told him I'm putting together a market report that we are going to send out every quarter that we will send him. But do any areas pop to the top of your head, Peter?
So I think honestly, my advice when folks ask me this is you want to look for the good school districts. Some folks try and like purchase property in sort of emerging parts of the city where it's like transitioning from kind of a bad area to a good area. They want to like capture that. That's very hard to do. It's kind of like speculating. You're not really sure like if this part of town is actually transforming or just like there was a couple things going on there for a year or two. So I generally recommend the good school districts are not going to steer you wrong in terms of long-term appreciation. The other thing we really like about good school districts is that the tenants that move into these homes really seem to take better care of the properties. They tend to stay longer in the properties, and they're willing to pay more in rent to be in that good school district because that's important to them. And they like, even if they don't have kids in school, they like living in like a low crime type area. So Allison's asking, how do you define a good school district? I don't know. I just kind of know because I'm been living here a long time. I'm sure there's rankings out there where you can find like school district rankings, like they grade the different school districts and stuff. And you do need to be careful here, like especially as a real estate agent, as those of you who are on the call already know, you don't want to be steering your clients one way or the other. But if I'm giving advice as an investor, one investor to another, that's my advice.
Well, I'm working on a blog on that exact topic right now, Peter. So check out our blog, everybody, and we'll tune
Yeah.
you in on a few good school districts.
All right, it's poll time. So I'm curious, like for those of you who own rental properties, whether you're working with a manager or not, which of these are you tracking or measuring in any kind of a consistent way, whether that be quarterly, annually? Which of these are you measuring? We'll give everyone a minute to vote here.
And this is multiple choice. So if you are measuring multiple of these on a regular basis, select everything that you're doing here. Allison asked, is this poll on your own property? I'm going to say yes on your investments in your portfolio, right?
Yep. George
If it's
said,
none
you
of
need
these,
none of
just
these.
don't select any of them. Yeah.
Yeah. Can you vote without checking any of them?
I
Will it
don't
let you
know.
do that? Oh, he says he won't let you do that. Oh, that's a bummer.
Okay. Well, good feedback there, George. I'll include that next time. Thank you.
All right, let's see the results.
Okay, we've got about 25% participating. People are still voting, so maybe we'll give it another second, but I think we have a clear winner here. All right, we're going to wrap up in about 10 seconds. So if you still need to vote. And to George's point, if it's none of these, put that in the chat for us. That's a good way to kind of signal that. Will says none. All right, I'm going to go ahead and end the poll. Share the results here. Overwhelmingly, NOI is the
Interesting.
winner.
Yeah, it would be really curious to run that again with none, because my guess is, frankly, most real estate owners and investors are not actually calculating these. They may have an intuitive sense of some of these numbers, but they're not actually doing the math. Just from my experience talking to hundreds of property owners. Okay, so let's talk about NOI. So NOI was the top result here. So what is NOI? So net operating income, and the key there is operating income. It's got a kind of a specific definition, and that is it excludes debt service and CapEx. Now there's a little bit of arguing within the community about whether CapEx should be above the line or not, meaning like the net operating income line, because a lot of times when you're looking at like a sophisticated commercial property pro forma, you'll see like NOI, and then there'll be like a CapEx and some other like debt service stuff, and then there'll be like a bottom line. So this idea of should CapEx be above or below the line is a little bit controversial. Everyone loves controversy among like financial reporting metrics, but for our purposes, we're going to say that it's below the line. So what does that mean? Excuse me. So if you take your income statement, so if you're tracking your income and expenses somewhere, or if your property manager is reporting it to you. So this is an example from a property that I own, 383 Naples Place in Westerville. And this is the 2024 income statement, also known as a P&L, profit and loss. So you can see that at the bottom there, it says net income, and I highlighted it, $20,000, just about $20,000. So that's going to be pretty close to your NOI for the property. There's a couple caveats here, especially if you're working with a property manager. If you paid any expenses out of pocket for the property, then obviously you would need to account for those and add them to the expenses here. And same thing, like if you collected rent from the tenant for like the first or second month before you transition to the property manager or something like that. So again, if you did any sort of payment or income yourself outside of what your property manager is reporting, you would need to account for that here. The other major item that's not going to be properly reflected on just a basic income statement from your property manager, or if you're just tracking in Excel, is what we call capital expenses, CapEx. So these are the items that I mentioned about whether or not they're above or below the line. But if your property manager, for example, if they replace the AC unit at your house, it goes out on a hot summer day and they say, the unit's 20 years old, we need to get a new one in there, it's $6,000. That's going to show up on this statement as a $6,000 expense, but the way that actually is handled in the accounting side when you do your taxes, and if you were to do this sort of accounting yourself, is that would be depreciated over the service life of that upgrade or improvement. And so I forget what the guidance is on AC. Let's say it's 12 years. So you would only be able to deduct 1/12 of that cost each year. And so the net operating income would actually go up from what is shown here, because what your property manager is going to do is they're just going to expense the whole thing, because we don't know how your accountant wants to treat different items. Some accountants will say anything over $1,000 has to be depreciated. Other accountants will say, no, that's way too conservative. So everyone has a different opinion about what should be depreciated and over how long. And so that's all tracked on like your taxes and everything with your accountant. So bear that in mind when you're looking at the statement that you get from your property manager. All right, so that's NOI. So once you have the NOI, and I went to the next slide here, you may be curious, how do I calculate my cap rate? Because when you're looking at commercial real estate especially, you're going to see this word cap rate thrown around all over the place. And it's an interesting metric to track. So the way to calculate cap rate is you just take that NOI, which we calculated in the previous slide, and then you divide it into the asset value. So if you're looking at buying a property, it would typically be the purchase price would be what they would be using for the cap rate. But you can calculate the cap rate at any time. You don't need to be buying or selling a property. So if we use that same example, so this is the same exact property from the last slide, $20,000 of net income divided by, let's say this property is worth $250,000. I just grabbed that from the auditor's site. I'm not actually sure what it's worth. That would be 0.08, which is 8%. So this would be an 8 cap. You would hear like the real estate brokers using that language. That's an 8 cap. That's a 6 cap. Well, that's what they're talking about. They're just talking about the cap rate. So cap rate is just a way to understand, hey, let's pretend I was buying this property in cash and I spent $250,000. Well, I can expect to get $20,000 of net income every year. So it's kind of like an 8% ROI, you could almost think of it. And so that would be an 8 cap. Now, this is ignoring a whole bunch of stuff like CapEx and like debt service and things like that. So when I say debt service, let me actually clarify that. So interest is an expense that won't show up in your NOI calculation, but it is an expense that you get to deduct on your taxes. So that's what I mean by debt service. And also like the principal pay down we talked about, those don't really factor in here, because when you're trying to look at something like NOI or cap rate, you want to look at that independent of like what's the current interest rate environment. Oh my gosh, everyone's talking about interest rate environment. We want to kind of ignore that, and we want to understand, how does this asset compare to other assets? Now you may have gotten a good interest rate on this and I may get a good interest rate on that, but if we kind of level that playing field, what does this look like? Great question from Allison here. Property taxes. So that's another item that you would need to add for your NOI calculation. Actually, that was a miss by me. I should have added in the property taxes and insurance, because those are items that do show up on an NOI. So the NOI of this property here is actually worse than what I calculated using this number, because you would need to back out. You need to reduce, basically expense the insurance and the taxes. That starts to get really kind of annoying to do when you have mortgages, because it's not coming straight out of like the property operating account. You're escrowing it over time, and that's all kinds of fun when you own rentals and you really need to dive into these details. But this cap rate, like this 8 cap, this 8%, you can kind of think about that like your stock dividend. Now, a lot of stocks used to pay dividends. I think it's kind of fallen out of favor, but if you own Bell Systems or, whatever, some old school blue chip stock, it would pay this big dividend. That's kind of the equivalent of like a cap rate. It's like you're throwing off operating cash, and the stock value may go up or down independent of the dividend. The dividend is like money that you're getting back in your hand without having to sell the stock. And that's kind of how you can think of cash flow from an operating real estate. So Allison says, to clarify, I would reflect the new fridge or microwave, but the CapEx like roof or HVAC would be spread over life expectancy. Exactly. And again, some accountants may even have you amortize that fridge over the, or, you know, that would be one of those items that may or may not be considered a capital item or just an expense. But yeah, that's exactly right. All right, let's look at return on equity. So if you want to calculate ROE, or return on equity, which is an interesting exercise, you're just going to take that same NOI number that we looked at and you're going to divide by the equity that you have in the property. And the equity that you have in the property, you probably know this, is just the value minus the debt owed, or the principal balance. So if we assume that the property is worth $250,000, just like the last slide, we have $80,000 left on this mortgage. That's real data. So we take $20,000 net operating income, which again, that's not quite right because we got to back out taxes and insurance. $250,000 value minus $80,000 in debt. You do that math, you end up with 11.8%. So 11.8% return on equity. And if your ROE is really low, like you may do this math, especially if you own the property outright and you don't have a mortgage, you may end up with an ROE of like 1 or 2%. It wouldn't be that unusual. And that really just shows that you haven't, you know, if the fancy finance people would say that your asset allocation isn't optimized, right? You haven't allocated or deployed the capital efficiently. Essentially, you have a lot of capital tied up in an asset that relative to the amount of money that's tied up in it, it's not generating very much money. Now, you may have put a very low down payment on that property originally when you bought it 20 years ago. And so your sort of return on investment, it looks amazing because, hey, I only put $20,000 down and it's generating like $20,000 a year now, 25 years later. So from that perspective, it may look great, but from the ROE perspective, it may look terrible because the property's worth so much and the rent coming off it isn't that much and you have no debt. So you have all this money tied up, just kind of not working very hard for you. So the easy solution to that is to just refinance. If you don't have any debt on the property, you could just do like a 50% loan to value mortgage. If you do already have a loan and just like your loan to value is really low, then you just do a cash out refi. Then you take that money that you get out of the property and you reinvest it in another property. You call up Brittany and you say, hey, Brittany, I want to buy a duplex. You know, what can we do here? So, so that's really what ROE is useful for, is understanding how your capital is deployed.
Peter, we have someone raising their hand here. Do we want to allow them to talk and ask a question here?
Sure. Yeah, let's do it.
Awesome. All right. Schlock, I permitted you to talk. Unmute your mic and ask away. Or if you want to put your question
maybe
in
hit the button by mistake.
Yeah, maybe.
I've done that.
Maybe. If you don't have a question,
you can type it too if you want. Yeah.
Yeah.
You guys loving this? We're really getting into the details here with these financial metrics and calculations. Can't believe we still have 36 people watching live. That's good. We're doing something right. All right, we'll move forward. Schlock, feel free to type your question or maybe just hit that by accident. All right, let's talk about IRR. So I love this metric, internal rate of return. It's the hardest one to calculate, but I think as I mentioned on that other slide, it really gives you the most complete picture of your performance. And you kind of need to break out Excel for this. This isn't something that you can just kind of back of the envelope, do the math. What you have to do is you need to plot the cash flows over a time series. And so you can see the example here I just grabbed off Investopedia. So year 0, that's the year you buy the asset. So negative $100,000, right? Because you're outlaying, like pretend you bought a $100,000 home in cash. And then each successive year, the cash flow, that's like the money that the property threw off after all expenses. So maybe the rent's like $1,500, and by the time you pay all the expenses, you're left with $10,000 in cash for that whole year. That would be pretty optimistic, actually. And then every year, rent goes up a little bit, and so the cash flow goes up a little bit. And then the 5th year, you sell the property. And it's gone up a lot. Wow, 50% in 5 years. That's pretty good. But if you owned property through 2022, you may have seen some kind of return like this. Wouldn't be that uncommon. So you plot those in Excel, and then you kind of select all these cells, which I can't really do because we're on a slideshow. And then you would do this IRR calc that Excel has built into it, and it will tell you the internal rate of return. And that's essentially, it's kind of hard to explain, but it's like the compounded annual rate of return that you enjoyed during the time that you had the money deployed into the asset. So this is really cool because it captures not only the cash flows, but it also captures the change in asset value over time, which is another way of just saying appreciation, right? This property appreciated from 100 to 150. And so when you add up the cash generated plus the appreciation, you get this IRR calculation that it spits out 18%. So this is a very sort of accurate and complete way to understand how your real estate portfolio is doing. George is asking, can you calculate IRR before you sell the asset? Yeah, you can just sort of make an assumption like, hey, what's the property worth today? Let's pretend I sold it. And you would actually want to do like net of fees. So like after all the realtor fees and closing costs and everything, you would just pop that number in for like the current year, just pretend that you sold it, and you'll be able to figure out what the IRR is. And if you do any kind of like real estate investing with a limited partnership, like as an LP, they call it, a lot of times the GP, the general partner in the deal, will be talking about the projected IRR. They'll say, well, we're going to take $50,000 of your dollars, and over the next 5 years, we project an IRR of 9% or whatever it is. And what they're doing there is they're making a lot of assumptions about, of course, they know how much they're going to pay for the property, but they're making assumptions about the cash flow that's going to be generated each year that they own the asset. And they're making assumptions about what the property is going to be worth when they sell it. And you can kind of guess on some of this stuff and get fairly close. Like, most real estate increases by some single digit percentage every year. And you could argue about whether it should be 3% or 5% or whatever, but, and it can end up being a pretty nice return, especially if you're using leverage, right? So what we haven't really talked about here is like, let's pretend they used a mortgage on this. So that would probably actually make a little more sense. Like, let's pretend they bought a $400,000 home and they put down $100,000. So you can kind of see how that would work. Like, then you wouldn't need the asset to appreciate by 50% to get 150 on the back end. I don't know if I'm explaining that well, but because you're sort of leveraged 4-to-1 when you use a mortgage with 25% down, even if the asset value only goes up a single digit percentage point every year, like your equity can end up growing like by multiples of what you paid. So Will's asking about sharing the spreadsheet. I didn't have a spreadsheet put together. This is literally just a screenshot from the report that, if you're a client, you would have gotten this year-end statement, this exact one. And then I just did kind of back of the envelope math for this stuff. And this is just a screenshot from the internet. So next month, we are going to be doing a lot more with spreadsheets and calculating pro formas and stuff. And I will have an Excel to share on that one. All right, we're coming up on an hour. So let me summarize here and we'll see if there's any more Q&A. So if I were to summarize all this, if I'm speaking with my mother about investing in real estate and she's asking for my best advice or how does she think about it? And this is actually a real thing that happens. She does ask me about real estate investing. You can't just look at cash flow to understand your real estate investing performance. There's a lot more to it. And I think I've hit that pretty hard. So I won't reiterate that. Holding long-term is the key to building wealth through real estate. If you're, selling after 2 years and complaining about how you didn't make any money, well, yeah, that makes sense. I wouldn't have expected you to make any money after just 2 years for the reasons that we discussed. You should probably start a spreadsheet to track your property performance using the metrics that we talked about. If you're a client and you're interested in doing this and you need a little help, I think that's something that a couple of our team members could probably help you with. Pick a couple of those metrics that you think make sense and Google, hey, how do I calculate ROE? You could even use ChatGPT to help you with some of this stuff. That's a great use case for that. And then as you're looking at the performance of your real estate portfolio, just don't forget to account for all 4 of these pillars of wealth building. One of our mission here at RO Property Management is to help real estate owners be successful with their investments, but we need them to have the complete picture in order to actually, figure out if they're being successful. So I mentioned earlier, it's not uncommon for a rental to spit out tax-free cash every year because of depreciation. We talked about depreciating appliances and large capital items, but you also depreciate the actual property itself. So when you buy the property, the IRS says, hey, you can't just write off the purchase price the year you bought it. You have to depreciate it over 27 and a half years. Well, that ends up being a lot of money every year that you get to write off your income. So you end up being able to take quite a bit of cash without paying tax on it in any given year. Now, there's a lot of details that go into that. This isn't tax advice, but it usually works out that way. If you're a real estate professional, which means you are in the business of dealing with real estate, either a real estate agent or a property manager, things get even better because you can have a paper loss on a rental property due to depreciation, and you can use that loss to offset what they call earned income, which would be W-2 income. So the classic scenario here is take a married couple. One person has a high-paying W-2 job. The other person is a realtor and does either low or high volume real estate transaction sales. And because they do married filing jointly and the one spouse is a real estate professional, if they own rental properties and they buy like one property a year, they end up paying like almost no taxes because this depreciation lets them offset so much of that W-2 income from the high earner. So it's a really cool thing. Last thing, and this is one of the most important things of the whole presentation. Real estate returns are lumpy. So we talked about all these different ways to calculate returns. What I didn't touch on until now is the fact that in any given month and in any given year, the numbers are going to swing all over the place. And that is something that's very hard for a lot of people to become comfortable with, especially folks who just kind of like lived in their house and moved out and decided to rent it. In other words, they didn't go into it with the idea of being a real estate investor in the first place. It's just something that sort of happened to them. And so this idea that like in one year you might actually have a loss, and you have a really good year, and then you have a normal year, and then you have a bad year, and then you have a great year. This is like psychologically very difficult for a lot of people. And it's not like a moral judgment. It's just like our brain is wired this way. Our brain is very sensitive to like downside protection. And so I want to help you as a real estate investor understand that you're going to have bad years. You're going to have expensive turns. You're going to have AC units break. And just because you have a bad year doesn't mean that you should sell, or that you're not doing well, or that the asset's not doing well. You need to do some of these calculations in order to actually figure that out. And so helping our clients develop this psychological resilience, the ability to deal with a bad month, a bad year, that's something that's really important to us at RO Property Management, and we're going to be hitting on this theme all year. Now, you may decide, I'm not up for that. I don't need that in my life. I got my own problems. I got enough stress. I don't need to be hearing from my property manager about my property not making money this year. No judgment. I get that. And it may just be time for you to sell and just, hey, I'm just going to reinvest my money in something else that's not so up and down, up and down, up and down, and doesn't need, 4 Excel sheets to calculate whether I'm actually, building wealth or not. I get it. But I want you to make an informed decision on that. And so that's why I shared this information. So that's all I got today. I felt like I talked really fast and hopefully delivered a lot of information. Let me know in the comments or shoot me an email if you felt like this was valuable and informative, something you want to hear more about. We can, we may have time next month if we want to do a little bit of a deeper dive on one of these. But that's what I have for today. Andrew, any closing thoughts? Oh, we got to do the price reveal. Let me bring Brittany back up. I almost forgot. And we are going to look at and reveal how much we think this property can rent for and what the purchase price is.
All right, so the property spotlight reveal. So the price is listed at $369,900. The rent potential is $2,349 a month. And then kind of to dig into like the financing incentives, like why people are going towards new builds and not necessarily resale houses is, I have buyers coming to me all the time. And the biggest problem people are facing right now is trying to find affordable housing. And a lot of people that waited to buy when the rates were 5.5, now they're closer to 7, their calculated payments are almost $300-$400 more just in interest because they waited. So what a lot of the new builders are doing, specifically in this slide we're talking about DR Horton is because they're using their in-house financing, they're able to offer, people that are actually going to occupy the houses, rates from 4 to 5.5, depending on, a lot of different variables, which is saving, a lot of people significant money just in interest alone. And it's actually giving people almost $100,000 in purchase power, just because of the interest rate difference alone between the new build with the lower interest rate versus, the current market interest rate. So what's great about this for an investor, if you're kind of looking to add properties to your portfolio, is they're actually also offering financing incentives for investor type loans. So right now they're about 5.6%, which is great. There's no current stipulations on how many you can purchase in a community. Another kind of incentive too is kind of as they are phasing out, there's going to be additional sections available too. And if you actually do purchase the property in cash versus using their financing, they'll knock $10,000 off their purchase price as well. So It's just kind of a good opportunity for whether you're kind of your first time home buyer, or if you're looking to add properties to your portfolio. In this case too, there's extra security too with everything being new. A lot of these type of builders, whether it's DR Horton or others, you'll have a 10-year warranty for structural, and then additional warranties in a 5-year and 1-year gap period too. So there's definitely a lot of security in that with capital expenses and whatnot.
Yeah, it certainly helps when everything's new.
Yeah.
Thank you for sharing that, Brittany. That's really interesting. And I already talked about final questions. That's everything. So we did record this today. So we'll have the recording sent out and available to watch. I think we share those on YouTube. And thank you, everybody, for coming.
Thank you for having me.
Thanks, everyone. You bet. Thanks, Brittany. Thanks, Peter. And we'll see you all next month on March 19th. Bye, everybody.
See you then.
Yeah.
Bye.